Hi, and welcome to Financial ChitChat. My name's Jerry Hill, and I'm going to be your host. And today's topic is a topic of what is a mortgage when it comes to buying a home. And this comes from a young viewer. Again, a lot of the young people growing up have not been educated in regards to credit or mortgages. It's really kind of a failure of our educational system. And I'm talking about kids who maybe even went through college for 4 years. They just don't know what all that means. And so I really want to explain what a mortgage is. When you go out to buy a home, and say the home cost $300,000, clearly you don't have $300,000. And so therefore, you need to go to a bank to get a loan, which is a mortgage. That's what mortgage is. It's a loan. And the bank steps in. And as your home goes through escrow, or in some states it's an attorney transaction, then that bank releases the funds for you then to be the owner of that home. Now what happens is there's an interest rate that's going to be attached to the money that the bank is lending you. Right now I think on a home loan it's about 5%. And the interest rate goes up and down depending on inflation, depending on mainly on inflation and what the banks believe they need to charge to make money. So when your bill comes due, you get your statement from the bank. The very first statement you get is going to show you your total in regards to what the mortgage is, and then it's going to tell you what the payment is that you need to make. And so you're going to make that payment, and then the mortgage company is going to be accumulating that interest. Let's say it's 5%. That's going to be accumulating as your year goes on. So your mortgage is being added to. Now, most home mortgages are 30-year mortgages. Not all of them. There's variations. There's different types. But I kind of want to keep it a little simple because that's most of the young people that are watching this are going to go and get that 30-year mortgage to go ahead and to buy that house. And so for the next 30 years, you're going to be required to make those payments. Most of the payments you're making for dozens of those years are going to be just covering the interest itself. And so they're lending you the money, a lot like a credit card company, but now you're having to make this payment for the mortgage. And so the question becomes, hey, what happens if I don't pay them or I can't pay them? Then what you do is you contact the bank, you let them know, and maybe they can arrange some kind of a different payment plan. But oftentimes what happens is people will just walk away from their home because technically that bank owns your home because they've lended you that money and they've become a mortgagee on your home. Your home is their collateral. That's the asset that you have is your home, and they lent you that money based on the idea that that asset was worth what they lended you the money for. But if you don't make the payment, then the bank will foreclose on your home. They'll become the owner of your home, and now you're going to have to go and find a new place to live. And what that does is it really destroys your credit score. We call that a FICO score, and I'm going to do a podcast on what is a FICO score, and we'll cover that. But at the end of the day, that's pretty much the basics on what is a mortgage and how it works. So I hope you found that helpful. I hope you found it informative. And I would tell you, before you get into a mortgage, just make sure you do your research, because not all banks are equal. And there are banks that have lower lending rates, which are interest rates, and there are banks that have higher interest rates. And so you can really save a lot of money by shopping around and finding the right bank who's willing to lend that money to you. So thank you very much for watching, and I hope to see you again soon.